Is SCHD the worst dividend ETF money can buy? In this video, we are going to break down exactly why SCHD has been significantly underperforming its competition, as well as which funds are significantly outperforming it, so that we may all make some nice dividend income. And last but not least, I'm going to give my take on SCHD and where we go from here after it's had one of its worst years ever. So I hope you guys do enjoy. Whether you're a fan of the Schwab fund or not, it's going to be some great information in this video. So before we get started, don't forget to like and subscribe. And now we'll roll that intro. Using this article by TheStreet.com, I want to showcase a lot of why SCHD was doing so well to now why it is doing so poorly. Starting off with what SCHD is and the goal behind this fund, because it was extremely popular and it still is. It had a history of strong dividend growth, high yield, and strong returns with low fees, which is what everyone's looking for. You want all these things, and it was also a safer choice than a lot of other options. Now, it's been significantly worse, underperforming almost all of its competition and being the just overall weaker dividend ETF out there. So we can actually see that it was once a top-rated fund. It is no longer that. In 2011, it launched with the premise to just target the best dividend stocks on the market. It was looking at dividend growth, dividend yield, and quality. That's all, because it wanted to produce a portfolio of these top 100 dividend stocks that would not only return well, but pay out consistent dividends. And for a long time, that worked really well. But then we saw some pretty drastic shifts. So we can actually see it was 9 years in the top third of the Morningstar large cap value category. That's where it was. It sat there for 9 years. Phenomenal performance. And that's what helped it grow to the popularity in which it has today. It is unheard of in the dividend ETF space to have that category, large cap value, for a dividend ETF. It doesn't make a lot of sense, but it was working for SCHD for almost a decade. It had a 5-star Morningstar rating for years. And again, this is what blows my mind with SCHD, because people that hold it know that it's a safer dividend vessel. Much safer, I will say, but it depends on kind of your opinion of safe now that we've been seeing its performance this year. Its AUM, or assets under management, the amount of money invested in the fund, was more than $71 billion. It was the second largest dividend ETF in the world, right behind Vanguard's VIG, which is also now outperforming SCHD pretty drastically. So what shifted? What happened? And what other funds are actually now beating SCHD? We should actually ask which ones are not beating SCHD, since it seems to have fallen so heavily. But before we jump into the reasoning behind why it's underperforming, let's take a look at some of these ETFs that are outperforming it and really see, is it that far behind the competition? If you're not familiar with a lot of the big names in the dividend and growth ETF space, we're going to cover them. Starting off with SCHD, the reason we're all here. Then we have DVO and QDVO. Both of these are by Amplify. We have DGRO by iShares. We have FDVV, the Fidelity High Dividend ETF, one of my personal favorites. And we have our two Vanguard funds, VIG and VYM, the Vanguard Dividend Appreciation Index and the Vanguard High Dividend Yield Index. Now, looking at our price return, we'll slide all the way down here, and we can see there is one that stands out as a big loser. Can you guess which one it's going to be? And now I know you might be thinking, well, this isn't including the dividends, and it's not. This is just price return. But I want to showcase the difference in the growth between all of these dividend ETFs. So not even factoring in the dividends yet. We can see our worst performer on our 1-year price return chart is SCHD, where it's down 6.8%. And now I know we all invest in dividends for different reasons. I'm a half growth, half dividend investor. I do love my dividends. Some people are interested in SCHD simply because it's almost no risk. But this is kind of showcasing that that's not accurate. It is down 6.8% at a time when the markets have been extremely hot. What the S&P 500 is up 20 something percent, QQQ or the Nasdaq 100 is up even higher than that. So how are we looking at SCHD overall being negative on the year when it comes to its growth and still underperforming these other ones? It would be one thing if all dividend ETFs were beaten down, but they're not. Devo is up 8.5%. QDVO is a newer fund and it's up 10.5%. DGRO is up 7, FDVV is up 8.5, VIG up 8, and VYM up 7. So not only is SCHD significantly below all of the others, but it is pretty drastic, the difference. It's down 10% plus compared to its closest competitor, which is VYM. And what's wild to me is, why is SCHD kind of staying on course with this? And we're going to talk about this as to why it is beaten down compared to the rest of them, but they are all pretty clumped together. QDVO is standing out, but the rest are pretty close. And then we have SCHD. So when I switch it to our total return, this is now going to include dividends. The story kind of stays the same. QDVO now jumps to being even more of an outlier, but SCHD is still negative 3.22%. And now the rest are doing significantly better. DGRO is up 9.5%, Devo almost 14, FDVV 12, VIG is up 9.8, and VYM 9.9. So how is SCHD negative? And why would anyone actually hold this fund? We're going to answer both of those questions right now. Now, this states that SCHD's performance is lagging, but it's much worse than that. You would have been significantly better off simply investing in the S&P 500 or in the Nasdaq 100 in comparison. And it all began in 2023. It has unfortunately been a bit of a downslide for SCHD since then, and it was peaking at this time. Everyone was talking about it. Every YouTube channel, every dividend-focused anything was talking about SCHD. But then the Mag 7 started to light up. If you don't know the Mag 7, there's a couple ETFs on the Mag 7. It is Google, Amazon, Microsoft, Apple, Tesla, Nvidia, and one more that I can never get all 7. But the Mag 7, these started to heat up. And if you go back and track how their performance has been, it's been outstanding. Although Apple has been lackluster this year, the rest have been absolutely booming. And that kind of changed a lot of things for SCHD and for dividend investors as a whole, because growth was heating up. So SCHD is underperforming as well the other dividend ETFs. So why is that? What makes it different from the rest? And why are they sticking with this strategy? Well, 9% of SCHD's allocation to technology stocks is compared to 35% with the S&P 500. That is a massive loss for SCHD because tech has been moving like crazy. The Mag 7 have been pushing the S&P 500 higher, and they are responsible for a lot of the gains. And so SCHD is simply missing out on those returns, as well as the sectors they're choosing to invest in. I don't know why Charles Schwab is deciding to put everything into energy and staples, especially as we've had a terrible 2025 when it comes to tariff news, when it comes to, honestly, war, everything that's impacting the staples and then energy on top of that. So it rebalanced in May, and it made additions to these two sectors. And I want to give my personal opinion on this because, not financial advice, I am a retail investor. I think that they were kind of hedging for a bad year. And this could be a big win for SCHD in the long run, but in the short term, it's looking awful. So in addition to the healthcare exposure, it has more than 50% of its portfolio in 3 of the worst performing sectors year to date, which is tough. Healthcare, consumer staples, and energy. Which is also interesting though, because my energy stocks have been doing really well. Energy Transfer, Enbridge, a lot of them are doing well. So what exactly is going on with SCHD that's pushing this thing so far down? Now, it also has almost zero growth stock exposure, which is wild. It's absolutely wild. And that's coming from someone that does invest primarily in dividends, but also in growth. You miss out substantially if you have zero growth exposure in the market we have been in. You can track anything. You can track Nvidia, you can track Tesla, you can track all of these different stocks over the last year to a couple years, and you are missing out like crazy. So, according to FactSet, the S&P 500 has 56% of the index allocated to growth stocks. Love to see it. It's worked well for the S&P and even better for the NASDAQ, focusing more on tech. SCHD has just 0.27% of the fund in growth. And what do you get with that? Terrible returns, because you are missing out on one of the hottest markets we've seen in a long time. Now, again, what still is a mystery to me, including why they're doing this with SCHD, is how are these dividend stocks held in SCHD doing so terribly? They are focusing in on dividend growth and dividend consistency in their ratings, and their rating system is just it's awful during the market that we have seen. But is this the end of SCHD? Is there any point in holding it? Should anyone even bother with this dividend ETF? I'm going to say yes. And hear me out. Although it has been a significant underperformer, there are a few key factors as to why I will be watching SCHD for the rest of 2025 and early 2026 as well. Now, I will say right off the bat, many of you may not be interested in SCHD because of the lower, 3.5% yield, the lower returns, the lower overall performance. But that's also one of the main reasons so many people are interested in this ETF. I have family members that utilize it simply because it's safer. Yes, you are missing out on some crazy growth opportunities, but let's zoom out, because 1 year does not really show the significance of this ETF. And while it's still a underperformer of these others, there is a lot of security when it comes to SCHD. And it's why people love this ETF. It is one of the lower risk options. It's got an expense ratio of 0.06%. Compared to some of these others, that is substantially lower. I mean, Devo and QDVO are 0.5% and a little above. So that's one reason right off the bat, it's cheaper to hold. On top of that, on the 5-year chart, it's still up 58%. So you're still averaging a 10% plus total return when you factor in those dividends as well as the growth. And that is what people seem to not really comprehend well. And while we may all be, who knows, at different stages of our investing journeys, when you get to a certain point where you don't want any risk whatsoever, SCHD seems to be the easiest answer. Now, if you're just starting out on your dividend journey and you're wanting to grow your portfolio and you're okay with higher risk, SCHD is not for you. But for me, SCHD does have a few small use cases. If I ever, I want to say I'm a riskier investor. I'm younger, I'm happier with my higher risk portfolios. But if I won the lottery or got a crazy inheritance of $500,000, SCHD would no doubt be a portion of that portfolio. Simply because you do get a long-term solid record. Yes, I know 2025 hasn't been good, but this dividend ETF is huge and popular for some good reasons. And again, if you're younger and you're higher risk, you're not going to want to throw every single bit of your paychecks into this necessarily. Not necessarily, it's up to you, of course, but you're wanting to grow. You're wanting to make the most of your money and your time in the market. And SCHD is phenomenal for safe investing. But when even looking at something like Devo or QDVO, which is still about half performing what SCHD has, it's 35% to the 58%, even more than half, even though it's been trading for significantly less time. It's higher risk. DGRO, FDVV is our best performer substantially, but higher risk. So in the times when the market is really solid, we can look at these things and go, oh, it's so simple. Why would anyone hold SCHD? But the minute everything hits the fan and your portfolio's down 5% every day for a week, and then significantly even more than that over a longer period of time, people are going to say, why would anyone ever hold anything other than SCHD? And it's how investing goes. If we had the hindsight or the foresight to see exactly what was going to happen, we could make this decision a lot easier. So my use case for SCHD, my second use case, would definitely be if we pulled into a crazy bear market. I would be averaging down on a lot of my favorite tech stocks and growth stocks as well, but utilizing SCHD's security, its safety, and its consistency would definitely be a no-brainer. Until we see that market, I will be steering clear, and I will be very happy with my FDVV, with my DGRO, with my Devo, and of course with my QQQI, with my TDAC, with my TSPY, and a number of others, WPay, a number of others that are higher risk that I'm okay with for now because the market has been rewarding higher risk investors. So it all comes down to your personal opinions and what you think the market is going to do. If you are a fan of SCHD, let me know in the comments. If you are a hater of SCHD, let me know in the comments. And I want to know if you guys are actually holding this ETF. So as always, thank you so much for watching. Don't forget to like and subscribe. And if you enjoyed this video, you're going to like these popping up on your screen right now. Last but not least, don't forget to spread some love today.